All right, this is Dr. Seitz, and today we're going to look at a problem where we're dealing with unearned revenue. And so I'm going to pull up the problem here that we're going to look at is unearned revenue with Jackson Legal Services. It was started when the firm collected a $12,000 cash retainer from a client on October 1st, year one. Jackson agreed to provide legal advice to the client for a one-year period beginning on the date of the cash receipt. The closing date for the law practice is on December 31st. So the very first thing we're going to have to do is record these transactions and then prepare limited financial statements with the amount of information that we have. So I'm going to pull up our information here that we have been working on. So requirement A asks us to basically prepare this information. And there were no beginning balances, so you can see the NAs all the way across. But our very first transaction was an increase in cash of $12,000, and it was a retainer. So that was basically a promise for us to complete legal services. So our cash increased, but our liabilities, and that's what unearned revenues are. Unearned revenues are a liability. It's unearned. So even though it's a revenue, we don't want to put it over here on the income statement because it's unearned. So that increases my liability. I now owe $12,000 worth of legal services. None of this is affected, but we do see a $12,000 cash inflow because, again, I am adjusting cash, and that's operating activity. The next one that we need to do is any adjustments that need to be made. And it said that this was on October 1st. Jackson agreed to provide legal services to the client for a one-year period beginning on the date of the receipt. So just assuming that it's equally earned throughout the period, we earned $12,000 a year. So 12,000 divided by 12 months. Of course, nice and easy, 1,000 a month. Okay, over the next year. But this happened in October. And so we have October 1st is when it was received, November and December. So we have 3 months that we can record as actual revenue because it's now the end of the period and I need to record this adjustment. So 3 months adjustment. So 3 months times $1,000, I can now decrease my unearned revenue by $3,000 and increase what I'm going to call real revenue by $3,000. So you're going to see here, I'm going to increase revenue over here, which increases my net income. Now notice I didn't record the full amount because I haven't worked for 12 months. I've only worked for 3 of those months. And it does not affect the cash flow, that particular statement, because that cash flow item would be recorded there when it was actually received at the beginning of October. All right. So year 2 now rolls around, and assuming this is the only thing that happens during the year, obviously there would be other things that happen during the year, but specifically looking at this transaction, how would this be affected under year 2? Well, I still have those other 9 months, so it's December, but then, so this is year 1. Year 2 would be January, right? January through September, and that equals 9 months. So there's my total equals 9 months for year 2. My total then would be 12 months, but I'm going to decrease my unearned revenue and increase my real revenue by 9,000. And then notice again that there's no cash flow because that cash was again received on year 1. But I do get to earn revenue. This is where the matching principle again comes into play. I'm earning revenue in the period in which it's actually earned and not necessarily when the cash is received. So the next thing that I want to do is prepare some quick and easy financial statements based on this one transaction. And so the amount of revenue earned in year 1, here's year 1, here's year 2. The amount of revenue earned in year 1 would be, there are no expenses, $3,000 in year 1 and $9,000 in year 2, okay, because of the different time periods and matching. My beginning retained earnings was 0 for year 1. I had net income of $3,000, 0, again, that drops down there, 0 dividends, and ending retained earnings of $3,000. That pops up there. Beginning balance of $3,000 plus net income that drops down here of $9,000, 0 dividends, and that's how my ending retained earnings gets to be $12,000. Cash is the same again, assuming that we're not paying out any expenses. Obviously we would, but just looking at this transaction and how it affects the financial statements is the purpose of this. I would have unearned revenue at the end of the year of 9,000 and then 0 at the end of the second year. Let's look at unearned revenue at the end of the first year would be 9,000. And then this is at the end of, this would be 9,000, 12 minus 3 would be 9,000. And then at the end of the second year, I would subtract out that second 9,000 to get 0. My equity and retained earnings, there's no common stock coming into play in this transaction. My equity and retained earnings would drop down from here. So it'd be 3,000. Drop down from here, be 12,000. Okay, so my total liabilities and stockholders' equity for both years would be 12,000. Okay, cash flow from operating activities, we received all of it in year 1. So there wouldn't be any investing in financing. So net change in cash would be 12,000. There was no beginning cash balance, and our ending cash balance is 12,000. Our ending cash balance becomes next year's beginning cash balance, which is 12,000. And assuming this is the only transaction, there were no cash transactions during the second year because all we did is recognize the revenue as it was actually received, not when the cash was actually paid. All right, this is another example of accrual accounting. So please make sure that you understand the difference between accrual accounting and cash basis accounting. Under cash basis accounting, you would have recorded all the revenue in the period in which the cash was received, which would be year 1, but that violates the matching principle. Let me know if you have any questions.